Think your RRSP is a guaranteed tax win? Here's the twist. That tax break today could turn into one of the biggest tax bills of your life later. Most Canadians never see it coming until it's too late. In this video, we're breaking down the hidden RRSP traps that your bank advisor probably isn't mentioning. By the end, you'll know exactly how to avoid thousands of dollars in surprise taxes when you retire. Number 1. RRSP withdrawals are fully taxable income. When you pull money out of your RRSP, whether during retirement or in an emergency, it's treated as regular income. That means if you withdraw during a high-income year, you could get bumped into a higher tax bracket and hand over 30, 40, even 50% to the CRA. Example, you retire with a healthy $600,000 RRSP and need $50,000 a year. If you also have CPP and OAS coming in, those RRSP withdrawals can push you into a higher bracket and eat a big chunk of your retirement cash. Number 2. Mandatory withdrawals through the RRIF. You can't keep your RRSP forever. By the end of the year you turn 71, you must convert it to a RRIF or buy an annuity. RRIFs force you to withdraw a minimum amount each year, whether you need the money or not, and every dollar counts as taxable income. Here's the problem. Those forced withdrawals can trigger OAS clawbacks. If your income crosses roughly $90,000, you start losing old age security benefits. Many retirees watch their OAS shrink simply because their RRIF payments are too big. Number 3. Withholding taxes are only the beginning. Take money out before retirement, and the bank withholds 10 to 30% on the spot. Many people think that's the full tax. It's not. It's just a prepayment. At tax time, if your actual bracket is higher, you'll owe even more. Example, you pulled $20,000 to cover a down payment. The bank withholds 20%, $4,000. But if your income puts you in a 35% bracket, you'll still owe another $3,000 when you file. Number 4. Inheritance shock. When you pass away, unless you leave the RRSP to a spouse or dependent child, the entire account is taxed as income in the year of death. That can push the estate into the highest bracket, wiping out up to half the account. Families expecting a smooth inheritance often discover a massive CRA bill instead. How to protect yourself. Balance RRSP contributions with a TFSA. TFSAs grow tax-free, and withdrawals don't count as income. Consider early, small withdrawals in low-income years to reduce future forced withdrawals. If you have a spouse, use spousal RRSPs to split income and lower taxes. Get professional advice before age 71 to plan RRIF conversion and OAS timing. RRSPs aren't bad, but they're not free money. They're a tax deferral, not a tax escape. The sooner you understand the rules, the more you keep. Stay informed and keep your money working for you. Subscribe for more smart Canadian money tips.